Before you risk your money in the market, you need to know if your strategy actually works. That's what backtesting is all about. I simply go back to old charts and test my strategy on past price movements. I'm not trying to predict what already happened. Without backtesting, you're trading with hope. With backtesting, you're trading with evidence. One reason many traders quit is because they lose confidence after just a few losing trades. Confidence doesn't come from winning every trade. It comes from knowing your strategy has worked consistently over time. Backtesting is simple. Open an old chart and hide the future candles. Move the chart forward one candle at a time. Every time your setup appears, ask yourself, would I take this trade if this were live? If the answer is yes, record it. Then keep repeating the process. Don't rush it. The goal isn't to find perfect trades. The goal is to see how your strategy performs over many trades. This is where many traders make mistakes. They change their rules halfway through testing. Don't do that. If your strategy says trade with the trend, wait for a break of structure, wait for a fair value gap, and enter on the pullback. Then follow those rules every single time. If you keep changing your rules, your results won't mean anything. Consistency is what gives you reliable data. Don't rely on your memory. Record every trade you take. Write down your entry, stop loss, take profit, whether the trade won or lost, your risk-to-reward ratio, and why you entered. This trading journal becomes one of your most valuable tools. The more information you collect, the easier it becomes to spot patterns and improve your strategy. One winning trade doesn't prove your strategy works, and one losing trade doesn't mean it's broken. That's why I recommend testing at least 100 trades. The more trades you test, the more reliable your results become. Trading is a game of probabilities, not guarantees. A large sample size helps you separate luck from a real trading edge. Backtesting and forward testing are both important, but they serve different purposes. Backtesting uses historical charts to see if your strategy has an edge. Forward testing uses a demo account to see if you can follow that strategy in live market conditions. I always backtest first, then forward test, and only after proving consistency do I move to a live account. Backtesting only works if you do it correctly. Don't change your rules to fit the past. Don't test only a few trades and expect reliable results. Don't ignore spreads, commissions, or risk management. And never use information you wouldn't have known at the time. The goal isn't to make your strategy look perfect. The goal is to discover how it performs in the real world. Once you've finished your backtesting, don't stop there. Study your results. Look at your win rate, your risk-to-reward ratio, your drawdowns, and your consistency. These numbers tell you whether your strategy truly has an edge. Remember, successful traders don't rely on hope. They rely on data. Keep testing, keep improving, and let your results guide your decisions.